On July 17, 2019, International Business Machines, or IBM, reported second quarter earnings results for the period ending June 30, 2019. This video provides an update on the company's dividend safety using its most recent operating results. Before we begin, I invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. With that out of the way, let's dig into IBM's dividend safety. To begin, let's talk about IBM's business model. IBM is a global supplier of technology, business, and cloud services. The company also supplies software and systems hardware. IBM has a market capitalization of $127 billion, with annual sales of nearly $80 billion. IBM is one of the world's most popular dividend growth stocks. The company's current dividend yield is above 4.5%. Moreover, IBM is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 24 consecutive years. Because of this, IBM qualifies to be a member of the Dividend Achievers, an exclusive group of dividend stocks with more than 10 years of consecutive dividend increases. Looking ahead, IBM is just 1 year away from becoming a member of the Dividend Aristocrats, an even more exclusive group of stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors interested in owning IBM stock will likely be interested in the safety of the company's current dividend payment. For the remainder of this video, we will discuss IBM's dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss IBM's dividend safety in the context of the company's current earnings. In the second quarter of fiscal 2019, IBM generated adjusted earnings per share of $3.17, which compared favorably to the $3.08 of adjusted earnings per share in the same period a year ago. For context, IBM currently pays a quarterly dividend of $1.62 per share, which implies a payout ratio of 51% in the most recent quarter. Looking out over a longer time horizon, the payout ratio is slightly higher, but well within a range we consider to be safe. IBM generated $5.42 of adjusted earnings per share in the first half of fiscal 2019. The company distributed $3.19 of common share dividends during the same time period for a dividend payout ratio of 59% in the full fiscal year. Using earnings, IBM's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare IBM's current dividend payment to its free cash flow. IBM generated $2.9 billion of cash flow from operating activities in the second quarter of fiscal 2019 and spent $431 million on capital expenditures during the same time period for free cash flow of approximately $2.5 billion. The company distributed $1.4 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 56%. Looking at over a longer time horizon, the company's payout ratio is lower. IBM generated $7.7 billion of cash flow from operating activities in the first half of fiscal 2019 and spent $1 billion on capital expenditures for free cash flow of approximately $6.7 billion. The company distributed $2.8 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 42%. Using free cash flow, our conclusion for IBM's dividend safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze IBM's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. IBM's performance during this time period is shown here. Despite a decline in 2009, IBM produced a 39% increase in adjusted earnings per share from 2007 to 2009. The company continued to make new highs in adjusted earnings per share in the years following the last recession. More importantly, though, the company's earnings still covered its dividend payment, and IBM continued its streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess IBM's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest rate would have to increase before its free cash flow would no longer cover its dividend payment. At the end of the second quarter of fiscal 2019, IBM had $73 billion of total debt outstanding. The company generated $348 million in interest expense in the most recent quarter, for a weighted average interest rate of 1.9%. The following image shows how changes to IBM's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, IBM's weighted average interest rate would need to rise to above the 4.9% level before its dividend would no longer be covered by free cash flow. Looking at just the second quarter, IBM's debt level is close to having an impact on the company's dividend safety moving forward. Looking out over a longer time horizon, our conclusion is different. For the first half of fiscal 2019, IBM generated $558 million in interest expense for a weighted average interest rate of 1.5%. The following image shows how changes to IBM's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, IBM's weighted average interest rate would need to rise to above the 11.9% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concern about the impact of the company's debt on IBM's dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on IBM's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.